So it's a real pleasure to be here with such an esteemed group of colleagues from academia and industry. And it's my great pleasure to come in support of Peter, who I've now known for quite a number of years, getting on for a decade. It's interesting listening to Justin mention about his time. My introduction into industry was into hedge funds at the time of the global financial crisis. Needless to say, I work in academia now, which probably tells you something about the risks that were taken at that point by the hedge fund industry. And I think it's just really interesting to see that that perspective of people who've gone through 2008-9. It still feels very immediate in my mind, but now I realize that actually it's sort of 14 years ago, which is kind of crazy. So, we think about that. So there's an entire generation of people who've come into finance, and COVID, yes, COVID was kind of an interesting crisis that affected the world in some particular ways. But I was commenting, and there's quite a lot of literature out there which sort of says the global financial crisis prepared us a lot for how businesses reacted to COVID. So if we think about it, if we'd had COVID, if we'd somehow managed to gloss over the global financial crisis and kept going, as in Peter's graph, without realizing all of those losses, if those BNP Paribas hedge funds had not gone bankrupt, if Lehman Brothers had somehow been bailed out, imagine where we'd have got to as COVID struck us. So there's a sort of one point that I always think about in terms of how risks can build up and how path dependencies can take place in this particular point. So just to introduce myself, I'm Julian Williams. I'm the head of department in finance at Durham University Business School. I thought I would try and put an atmospheric picture of the northeast of England, because this is kind of infamous for rain. So I found this photograph that one of my colleagues had taken, of the business school, looking back on a dark evening with the foreboding clouds. So I hope this will be a lighter talk than the picture, but just to give you an idea. So Durham is one of the largest business schools in the UK. It's also one of the 3 oldest. So in 1965, after the creation of MIT and Sloan Business School, School of Management, there was sort of a call out from the UK government to create 2 actually new business schools. In the end, 3 business schools were created: Manchester Business School, Durham Business School, and London Business School. And those are the 3 oldest in the UK. And obviously, as I said, we're one of the largest. We sit in the University of Durham, which I'm sure everybody who's from the UK will know very well. Often when you say from the University of Durham to our friends in North America, they say, "Oh, you're from North Carolina." And it's like, no, sorry, we do have an affiliation with Duke, but it's a slightly different one. We're the 3rd oldest university in the UK, third oldest university in England, after Oxford and Cambridge, and jointly we were founded about the same time as University College London. The university has, as I said, this sort of very old business school. It's been here. We have courses, for example, I used to teach one particular course that's actually been running since like 1966. So, those sorts of things there, but we are also very forward-looking and very technology-orientated. And we have the largest standalone department in finance in the UK, with 50 academic staff here. So Peter is a valued member of a large group of people within my department. Our key specialties are banking, corporate finance, regulation, and obviously operational risk. And I would see myself as an operational risk and technology person. And I put some links here, and of course the slides will be distributed. Get to the next one. So we're sort of say 5 years to date. Actually, Peter, the first time I met was 9 years ago. But we've had a program for the last 5 years. We've been building that up. We published a couple of papers together, and it's been a quite successful run in terms of academic work. As we discussed earlier on in our preamble, as it were, as we were meeting up, one of the more enjoyable parts of this has been a couple of years ago, just before COVID, where We got to test out a large chunk of the risk accounting metrics with the Fed in Washington, the central group there, and the primary economics group there, but led by one of the colleagues who Peter knows for a long time. And that was really useful. And one of the graphics that Peter just popped up from his previous paper, it's sort of the starting point was going into these gigantic databases that the Chicago Fed particularly collects and allows our public access to, which you can then go through and have a look at exactly how banks are operating. So you end up with thousands and thousands and thousands of books effectively that you can look at. So this has been a fairly deep collaboration that we've had, and obviously Peter has been a research fellow here in Durham. He comes in and lectures to our master's degree students and our PhD students on risk and financial, anything to do with the financial structure of banks as well as the operational structure of banks. And this is great because I think one of the things we haven't sort of paid tribute to is Peter's deep experience in industry, particularly with JP Morgan Chase Manhattan, where obviously he held such a senior role all over the world. And I think this is where a lot of the inherent ideas came from, was actually looking at the operational risk within the financial sector. The other things that I thought was kind of interesting from the previous discussions was that from colleagues, just a general discussion around things like accounting frameworks and risk accounting frameworks in this particular case, and the sort of the elaboration of that and the need for that. It is very interesting that if we think about particularly accruals. And, believe it or not, although I'm a professor of finance, I used to set the financial management paper for one of the UK Accounting Standards Board in England and Wales. And what you see with this is that you have an inherent time frame, and you're thinking about time frames looking forward and backwards. But we don't sort of begin to then sort of work out exactly what the contingencies in the states might be that could occur from operational risk. And we can see operational risk occurring. We find, we observe it in media articles, we sit down and we observe it by talking to professionals, but we don't have a framework for understanding and characterizing the suite of outcomes that could happen. And when we're storing up risk, and that's one of the reasons why the risk unit and the way that Peter has actually developed this is important, because it says to us, are we concentrating activity in certain areas? Are we creating books which are generating income, but we don't really know inherently what the asset risk will be? Are there things in there? Do we have an opaque product? Is there a product that we don't really understand how it's generating its returns and what future liabilities could come in, right? And if we think about how future development of business throughout the world, we can think about things like, decentralized autonomous organizations, the blockchain based work there. If we think about these sorts of developments, then it becomes quite sort of scary as we think about what these sort of micro multinationals versus macro multinationals, what would happen if we had a DAO that was bought by a large multinational? Are we going to see suddenly large asset losses and write-downs caused by technical risk and operational risk that suddenly becomes embedded within that framework? So it's important for us to have something. We've got to have something. Okay, Peter and I spend a lot of time debating whether risk accounting is the best, approach, and we generally are now thinking that it is, getting towards the best approach, or it is, the only game in town, really. There are still things in terms of things like additive risks. There's an additive risk element to risk accounting, where we're having to add things together. We're trying to measurement of adding risks together. So those are things that that we understand, but at least we know them, and they're transparent, and we've discussed them, and we have papers that discuss how these aggregation techniques work. And so I think that's important. So I'll finish off with some ideas about the operational side, about how we are looking to develop the risk accounting core. And obviously we have some competitors around. We've seen that Harvard have made a stamp there, and this was mentioned by Peter. That's obviously, they've gone for a much more qualitative view, which that could be attractive in certain respects, because it doesn't mean that you're, as Peter would say, shifting over on the actual quantified risk that you're going to measure against what you're already reporting. So it doesn't have that frightening element of, oh my gosh, now we have a new metric that we have to manage. But that does eliminate lots of the advantages of this quantification, which is really important. So what are we doing here in Durham? Well, obviously we're building a research group. We've built a research group around it. Peter is a visiting fellow in the Center for Banking and Institutions and Development. Peter obviously works a lot with the large cohorts of faculty that we have here. We're developing a series of training modules that will be there, and they're not just done to sort of, okay, it's a training module in risk accounting, and of course, then we have wedded that. It's training in risk management in general, and then looking at things like how risk units and risk accounting could actually then solve some of these problems. So it's not a hard sales pitch in that way. What it is a kind of saying, here are different techniques, and what we'd like to do is compare the menu of techniques in that way, because we're academics and we have to look at things from this dispassionate viewpoint. And Felix tomorrow will give you some ideas about what it means to do these kinds of activities. And then we're going to develop a series of courses. We develop, obviously, graduate courses in which there's a degree certificate at the end, CPD accreditation. We've obviously already, as we just mentioned, talked to government regulators, academics, practitioners. We've invited over, regulators. We have a central bank forum once a term where central bankers come over to look at how banks, to discuss operational risks in banks and financial risks in banks. And effectively then provide a research arm to the Risk Accounting Standards Board, and provide that dispassionate, critical friend. So that's the important thing, is to have that critical friend. We don't always say, oh, this is wonderful, everything's perfect. There are definitely things where we would say, look, this needs to be improved, and then this is continuous improvement. And if we think about that, if we look at various different academic interfaces with different regulatory bodies, it's important to have that critical friend to actually develop and actually push it forward. Say when are things working and when are things not working, and that's what our role is in that way. So just to sort of give you an idea of how we sort of integrated with that, obviously I sit on the advisory board and provide part of the sort of the Risk Accounting Standards Board, but as the head of department, I also run the Risk Accounting Research Group, and then I can then sort of determine and push forward the agenda there. And as just to give you an idea, this has been a very long-term engagement with Peter, and we've given Peter, we want to give Peter his sort of wings, as it were, to actually then use the resources of a department in this way. And I think that's why this has bloomed, because we've not tried to push and cajole him into sort of doing things that he's sort of outside of his expertise, and try and make sure that we sort of focus in on risk accounting from that perspective. And I think we've demonstrated a multi-year, and I said nearly a decade's worth of support, and in the last 5 years, a 5-year support plan from there. And I think that's probably where I shall leave it. So thank you very much, and I hope everybody will pop back tomorrow and see my colleague Felix and the other speakers. And thank you very much to everybody. Thank you very much to Rachel, and that's my finish there. Thank you.